Yeah. The agenda of the meeting is first a brief introduction will be given by me. After that, investor presentation will be given by Shreya Madam, and Q&A session will be held. So next. So I would like to share the guidelines of the call. All the participants are kept on listen-only mode by the host. All the participants are requested to not to record the call. And during the Q&A session, we request you to introduce yourself with your name, organization name, and then your question. Next. So we'll move to the introduction of the company. Dear participants, welcome to the Q3 of financial year 2025-26 earning call and investor presentation of Synergy Green Industries. Synergy Green Industries Limited is one of the India's leading state-of-art foundries producing SGIN, CREAN, and steel casting for wind turbines, wind gearbox, and general engineering industries in the weight range of 3 to 30 metric tons. The Synergy Green Industries has installed capacity of 30,000 metric ton per annum and is in process of upgrading up to 45,000 metric ton. The company houses best-in-class equipment, IT infrastructure, and quality testing facilities, and is a top supplier to a major wind OEMs as well as leading gearbox players in the world. SGIL is a part of the Shirgaonkar Group, which has diversified business interest over its 80-plus year history spanning across sugar manufacturing, foundries, hospitality, and market research, among others. We have the panelists for today: Mr. V.S. Reddy, Executive Director, Ms. Shreya Shirgaonkar, AVP Commercials, and Mr. Nilesh Markar, that is myself, Company Secretary of a company. Now I would request Ms. Shreya Madam to give the highlights of Q3 financial performance of the company.
Good evening, everyone, and thank you for joining today's call. The presentation is divided between industry overview, company profile, and business performance. And for the purpose of today's call, I'll be skipping over the first part and directly covering the company profile as well as business performance. So Synergy Green has state-of-the-art facilities based out of Kolhapur, Maharashtra. With the current expansion in progress, we're now split between foundry and machining. In the foundry, we can produce up to 30 metric ton single-piece castings, and we are in the process of upgrading to 45,000 metric tons. In the machining, we can also machine 30 metric ton single-piece castings, and we're in the process of setting up the machine shop for 20,000 tons per annum capacity. Additionally, we're also expanding our renewables portfolio and have installed 10 megawatt of solars to support around 15,000 tons per annum. Our products are split between wind castings, about 70% goes to this segment. Gearbox castings for the wind industry add about 15% more, and the balance goes to the non-wind castings of mining, plastic injection parts, pumps, turbine casings, as well as coal pulverizers. We're trusted by 50% of the world's top wind OEMs. Out of these, a few business development updates that I'd like to highlight for today's call. We've successfully completed the development of 5 megawatt components for Nordex, which has created opportunities for synergy across both domestic as well as export markets. Proto development for Envision has been successfully completed, and we've received the go-ahead for serial supply in FY27. However, this business has been slower than expected for the offtake. We've also secured a pulverizer order from L&T, and upon successful development of this, we're expected to contribute to the non-wind segment. And finally, we've received facility approval from BHEL for the production of power equipment castings. Moving to the business performance. Our capacity utilization continues to be at peak levels. In the current FY, as of 31st December 2025, we've reached 89% of capacity based on the 30,000 ton per annum capacity levels. Now coming to the summary of unaudited financial results. For the quarter ended 31st December 2025, the total income for the quarter dropped by 4.8% over the same period in the previous financial year. The PBDIT stood at 9.62 crores, which is around 34% drop over the same period in the previous year, and PBDIT margin stood at 10.32%. Similarly, looking at the 9-month ended data, we've had a 4.8% drop in the 9-month total income, which stands at 252.92 crores, and the PBDIT stands at 34.48 crores, a 10.2% drop. The PBDIT margins for the 9 months ended 31st December stand at 3.63%. There are a few parameters that have impacted our profitability in the third quarter, as well as that's reflected in the 9-month data. There have been higher outsourcing costs that are incurred during the relocation of our equipment from our old unit to the new unit. There have also been increase in operating expenses, including manpower and other overheads, which have happened during the establishment phase of the new unit. Increased finance costs and depreciation have risen from the expansion activity. These are all related to the CapEx plan that we have, a program that we have as an ongoing activity. Additionally, we've also taken a provision for the new labor code impact on the financials. Finally, on the customer's end, we have lower export realizations in the third quarter. This is because of discounted pricing that kicked in Q3, which was factoring in in-house machining facilities that is currently under development. A summary of the unaudited financial results for the balance sheet for Q3 FY26. The long-term borrowings and non-current assets have increased on account of the CapEx or capital advances. Drawing your attention to the short-term borrowings and other current liabilities, there has been a corresponding increase in production as well as inventory to take care of current quarter sales, as well as advances to suppliers on account of capital purchases. Here's a brief overview of our financials, looking at revenue streams and estimates for the year. The revenue growth in the 9 months ended 31st December was muted, and this was majorly due to the delayed ramp-up of new wind product segments that we were expecting, as well as disruptions from the ongoing expansion activities that are currently taking place. Basis this, our current order book, the full year revenue growth, we're expecting around a 5% increase in the previous year. This means that the executable order book projection for the whole year stands at around 380 crores. Looking at the PBDIT margins over the period, the PBDIT margins dropped marginally from 14.44% in 9 months FY25 to 13.63% in 9 months FY26. For the full year FY26, margins are predicted to be around 14%, considering the ongoing expansion activities. Taking a look at the progress of the CapEx plan and its status, the foundry expansion is currently in progress, and equipment commissioning is at its final stage, which is expected to be completed in the current quarter. The captive renewable power plant has been completed and operational since October 25. And in-house machining, the first phase of machining machines have been set up and are operational. We've also successfully developed the proto castings and got them first time right in the machine shop as well as paint shop from our facilities. The phase 2 of machines to be commissioned are expected to be commissioned in the first quarter or FY27. Finally, taking a look at the FY25-26 performance outlook, the revenue growth is projected at 5% in FY26 over the previous year. This has been impacted by delayed ramp-up of new wind segment products and disruptions from the ongoing activities as mentioned earlier. We are expecting export revenues to remain stable, close to the previous year. PBDIT margins, however, are expected to be 14% for the current year, considering the ongoing CapEx plan. With this, I'll close the presentation and open the floor for Q&A. Thank you.
So, good evening, everyone. Thank you for joining this call. Now, I would like to take you through the Q&A session. I call the names, and please unmute yourself and go ahead with your question. The first question is Mr. Nitin Dharmavat, sir. Please unmute yourself and go ahead with your question, sir.
Yeah, thank you for the opportunity, sir. So first of all, I wanted to understand, were we not aware about, the changes in the numbers which are now, suggested in the previous quarter also, because this expansion that we are seeing that is responsible primarily because of the margin changes and the top line, projections. So were we not aware of, or is it something that has got developed in last, 3 months?
See, first thing is we were expecting like last quarter, you are right. We were projecting retaining a growth rate of around 20%. We had some signs of maybe around 3-4% impact of that, but we don't wanted to correct it because of the marginal 3-4% kind of the revenue drop. Actually, there are two major events. The last quarter, we were expecting a big takeoff from the Envision, the product development. Actually, we have completed the product development. Due to some commercial reason, these guys have dragged the serial productionization of that product. That was one. And the second thing is regarding the expansion activity. We have already completed the commissioning of the one production, the continuous stand mixer. We were expecting some kind of a takeoff, but we did not anticipate the kind of disruption in relocating the plant. It was enormous. It was only a simple movement of the castings from here to the unit 2. But actually, the entire set of the people moving over there, settling down, it took much more than what the way we were anticipating. So these are two major reasons why we need to revise our guidance.
So you mentioned about there is a disruption from the customer side also. What is the impact now? Are they lifting the things or they are not?
See, Envision, the customer, what happened? There was some specific query came from China. In fact, I had a purchase order and also I got a letter of credit in my hand, and they have raised something related to the warranty related issues. So because of that, then it went into the clarification. We have to hold the production actually. So finally, we got a clearance now. We are moving into the pre-serial and the serial activity. So the whole thing of Envision, which we were anticipating a business in the current year, almost around 30 crores business, which we were expecting, that is getting spilled over to the Q1 of next year onwards section. This we were not anticipate, because initially they took a lot of time in moving into the production. But when I had a purchase order and letter of credit in my hand, we were very sure about it that things will move. But in between, the project has to hold because of the some commercial discussions, and then finally it got clearance actually.
So are we saying that this is not cancelled? This is just got postponed. The first quarter, this number will be visible. Are we saying this way?
Yes, you are right. Yes.
So the same number, there is no change in the top line. Only the thing is that got shifted by one quarter.
Yeah, 1 quarter. You are right. You are right.
And we'll be able to deliver it despite having the challenges in terms of our shifting the operations from one location to another, or will there be some delay?
Yeah, this shifting has already been completed actually. This we did the month of November. We relocated to October end or November beginning. We relocated our plant to the new unit actually. Now the sequence is like this. The existing plant has got 3 major operations. I'm talking in the past: molding, melting, and fettling. So what we did is we removed the fettling section from here and taken to the new unit. Whatever the space is created by removing the fettling, we are adding a second production line. The first job is to move this activity to the new unit. That we are done in the month of October or November. Now we are completing the balance of the civil activity. That is also completed. One equipment is erected. The second equipment has to be erected. With that, the expansion activity get completed actually. So I don't see any impact onto either order book or into terms of the execution actually. Most probably this impact should be a postponement of the whole subject by a quarter actually.
So we are saying that foundry and in-house machining, both the things are complete. Foundry is something which is getting completed in this quarter, right? Q4.
You're right. Yeah.
So was there any delay in that also from the last discussion?
Yeah, machining, there was no delay. See, we have given the guidance of the two phases. Phase 1 is completed as per the original the plan, and the phase 2 we are given a March. So both the things are happening maybe 3-4 weeks maximum. If at one of the equipment, total 6 machines were installing. The one machine may get because there was a shipment delay from China to get that machine. So barring that, I don't see any significant delay in the machining action. Second thing is, after commissioning of the machining, we have already successfully developed this, because this was one major technical hurdle which we have to go through, because we are a foundry guys for the last 1.5 decade. Then machining is a new technology. I'm happy to share that we got the right first component perfectly all right. And in fact, we got the approval from Vestas and also Senvian actually. Now we are gradually ramping up. And plus, we are also getting approval from the various other clients. That activity is going on. In fact, last week only we got the this quality certificates from the ISO, and all those things are happening actually. So the machine shop is in line with the way we have planned.
So the margin improvement that we are talking about is not happening in this financial year, in this quarter. Maybe next quarter onwards we'll see, or will there be some more time for stabilization of the operations of machining and the foundry?
I don't see many this thing. It may be a gradual ramp up. Particularly this quarter, we were also not anticipating to go down below the previous quarter. This thing, maybe a 1% here and there, mainly because of the we have added a lot of manpower to the new unit, including the machining, and there are a lot of development activities are happening. Apart from that, simultaneously, we are also doing a lot of product development and capacity development. Both the things simultaneously happening, So these expenses have come in this quarter, and without corresponding realization of the output from the machine shop. Now, which will start gradually giving accruing the benefits from the machine shop from the Q1 onwards.
Yeah, because last year I remember that we were saying something like 500 crores plus kind of revenue possibilities. Now we are talking about only 5% top line growth, if I'm not wrong. Just correct me if I'm wrong.
No. So, this year we are not given a 500 crores top line. If you go back to the holiday, this was given for the next year, not for the
next year. Next year.
Next year I don't see any change in our guidance actually. That should be intact.
Okay, so 500 crore plus for the next year is intact as of now.
Yes.
We have the sufficient orders for that, right?
Yes, absolutely.
And second is about the margins. Will we have the same margins, or will there be an improvement in the margin because we have now deployed the machining also in house?
It should go up. Definitely, it will go up. See, at least I expect minimum 16% plus kind of the margins for as far as the next financial year is concerned. Actually,
So what is the risk you see over there in top line and bottom line for next year?
See, as far as the top line is concerned, order book point of view, we have developed 4 major new OEMs, whether it is Nordex, Senvian 4 megawatt platform, Envision, and Adani. These are the 4 new products which we added. Really, if they give the orders based on the projections what they were, I don't have a capacity to produce that much of castings. So we are discounting something one or the other customer even doesn't perform. Still, I should be able to make a 500 crores plus kind of revenue. So looking at this situation, I don't see any big challenge as far as the top line of 500 crores is concerned. Actually, The second part is, as far as the margins are concerned, the key target of enhancing the margins were coming from the 2 aspects. Solar is a very passive thing. Actually, once you install, you get the electricity generated and it will get contribute to your margin. There is no rocket science in it. The second part is the machining. Actually, So machining, the major hurdle of developing the product and technology proved, that part we have done it. Now, only thing what we need to complete is successfully complete the balance of the 3 machines erection and execute the product. I don't see much bigger risk on the other side as well. Actually, In fact, our basis of margin expansion is totally based upon simple logistic cost saving. Today, what is happening is, for the US market, we're taking our castings all the way to Chennai and getting back to for the US exports. So almost 3% kind of the logistic cost we are going to save to avoid the transportation to the Chennai and getting it machined. Actually, plus the savings on account of in-house machining. These are the 2 drivers which I don't think fundamentally has gone away anywhere. Actually, because we are going to do next door. So these costs should definitely accrue with us.
I understand. Because last time I remember that we were talking much bigger margin expansion, but today you seem to be more conservative. So that's why I was a little concerned. Are we saving sufficiently, or are we looking at some other additional risk?
No. See, if you really honest, on our this thing doesn't change. 18 to 20% margin is 100% intact. I don't see any reason it will go away. When you asked about the next year how it is going to be, because the first machine is going, all the machines are getting commissioned in the March or April. So the maybe a 1 quarter kind of thing it may take off in terms of the getting the full potential margin getting added up. That's why I'm telling. Probably if you look at the second half of the quarter, we may be clocking 18 to 20% kind of thing. But I'm taking on a weighted average role. At no cost, it should not go anything actually. See, 100 basis point margin always keep on oscillating because of the commodity cycle and what you call the customer realization. Today, if you look at the kind of commodity, the way it is moving and a daily very volatile kind of thing, particularly I'm talking about from January onwards, the commodity prices have gone up by 8 to 10%. Actually, that's the kind of thing. But I'll get the correction from the customer, but it will happen with a 1 quarter lag actually, So these are the various because the copper has moved up, the other commodities the way it is tracing. Barring that, I don't see any risk from the customer side or anything because the prices are frozen. I have got a contracts in my hand. The only thing it can affect my margin is the commodity action. That too, if at all happens, it happens impact for a quarter and it gets neutralized in the next quarter because there is a back-to-back hedging from the customer on the commodity actually.
Okay, my final question is. What do you see about the impact of the trade deals that have happened? Is there any impact on us? Was the tariffs which were imposed in between, was it also impacting us? So just wanted to have your thoughts on that as well.
It's a very important subject you raised. In fact, in the past, even though no customers can ask for a 50% discount corresponding to the 50% trade tariff barriers, actually, but always there will be some element of pressure. If not 50%, can you contribute for 2%, 3%? This kind of margin pressure always will be there when that kind of tariff is sitting on our head, actually, Neither customer can leave us, nor we can leave the customer, actually, We have to carry forward. But there is some element of pricing pressure when it comes to such a kind of 50% kind of margin is there on our head. But now, since this has got relieved, I don't see that kind of the impact. The second important thing is soon after margin, tariff was announced, waiver of tariff was announced. I got an immediate call from some of the US clients. So I'm expecting a big order book. Now he is saying, don't stop the production, please go ahead with the full speed. Means this is the kind of the positive impact what I'm listening from the thing.
So what is the capacity utilization currently?
See, if you consider the existing 30,000 tons kind of capacity, we are almost doing around 90% plus kind of the capacity utilization. But as I told in the previous, soon after we relocated our new unit, we have started one machine. For example, we were handling a production of 30 to 45,000 tons. So now current month, I have got additional 5,000 tons extra production is going on because partially I have already started a production from the new line actually, But to get the all 15,000 tons addition, so that I need to finish the second of the equipment, that automation line, that erection is going on. If that is done, the complete thing will be there. So today the capacity, like last month, we have done a highest production, almost 2,800 tons kind of thing, which was historically 10% higher than my previous, the best production actually,
We got it, sir. I wish you best. Just a closing comment from my side. Wishing you best. And markets does not just like sometimes the surprises which has come today's result. Maybe we can be a little conservative on that side, but you are the best judge for the situation. Thank you and wishing you best, sir.
Yeah, thank you. Just I want to add a point. Of course, you are rightly pointed. We are also taking due care that we don't give any surprise. We keep a lot of things before commenting something on the outside, But certain cases, what happens, like if the people, our team, customers in our hand, we know what they're going. But when you do a project like this, see, if you look at the capex, historically in the last 13 years, we've done about 200 crores capex. This year alone, we're doing 200 crores capex. Means it's a 15 years worth capex we're doing in 1 year, actually, So the capex calls for the involvement of a lot of external people. Even though we do a lot of due diligence before placing an orders and all. For example, particularly I'm talking civil guys, the way they commit with the penalty orders they take, and the reality what they execute is totally different than what we think, So these are the challenges beyond our control, actually, If somebody is agreed an order, has taken a commitment, but he doesn't execute according to that, I have very little control on the moving that guy to someone else, actually. These are the challenges, the civil execution, the related things which project got impacted, actually,
Yes, civil guys may be pardoned by the company, but markets do not pardon very easily. So we need to be a little sensitive about this fact. But I'm sure that you've done fantastic job and you will do well next year also. I wish you good luck, sir.
Thanks a lot, sir. Thank you, sir. Mr. Pratham Ragani, can you please unmute yourself and go ahead?
Hi, sir. This is Parth here. Hope you're doing well.
Yeah. Okay. Yes, please.
So I think the previous participant has covered quite a few questions. Obviously, the current quarter results were not good. So just some sense on you're still guiding for a 5% growth next quarter, which is about 125 crore in the next one, which would be our highest quarter by a mile. Do you think we can achieve this, or maybe we just tone down our expectation right now and not give a negative surprise next one?
No. I don't see any significant thing. See, because I will share one more thing. The last quarter we were expecting 105. Even it was a surprising thing for me as well. Means we were not expecting these kind of numbers. Otherwise, we would have given this guidance in the previous quarter. So actually. What happened physically when we were relocating the plant from unit 1 to unit 2, there was a disruption. Means it's much bigger disruption than the way we thought actually. Particularly, people are accustomed to the existing unit and they are well infrastructure, everything settled down actually. If I move 300 people from one plant to the other plant, so it's not like going to the another office next day morning and starting in a full speed actually. So they come out with a lot of small things that is not there, this is not there and all. So there was a disruption. Now because of that, I need to postpone certain schedules from Vestas particularly. I'm talking, I have to push back the request. Otherwise, this sales would not have dropped so significantly. I had inventory, it is lying over there, but I'm not able to push because there is disruption. Inventory is lying in my hand. So these are the challenges what happened. Now, having settled down the unit 1, I don't see any big surprise as far as the current quarter guidance is. We should be able to fairly able to do that actually.
Okay. And second, sir, I think the solar capex would already be on stream. So, have we seen some meaningful cost saving because the internal power generation, or maybe some of the benefit will still take a quarter or two for it to fully reflect?
As far as solar is concerned, it is already delivering the results. Almost we are saving around 60 to 70 lakhs worth of the electricity bill on our book. It is happening post payment of the transmission charges and all those things. Again, it has not translated into the profitability because the how it flows is the cost of manufacturing first to the work in progress, then finally sales happens. This gets translated into profitability actually. Since we started in the mid of October, so this whatever the savings it has gone into the work in progress, something it should improve in the current quarter actually. Like if you look at last quarter, we had about 10.3. There are a couple of things in the current quarter things. As far as positivity is concerned, solar already confirmed generation is happening. That will we add positive to the margin. That's one. As far as the machining is concerned, again development. I'm not expecting a very big contribution, but some kind of small contribution should be coming from the machining. The third part is since we are going to do significantly higher volume in the last quarter, it will also give some kind of the cost benefit. And the negative side, what I'm looking at, still we are doing a lot of development activities. Machining related expenses will be there because that is a new overhead. If I have to spell out around 250 people we are recruited for the new plant actually, so that manpower cost, the hang will be there. That is one. And third thing is, particularly after January, there is a little bit more volatility in the commodity actually. So that may be a small thing. So that's why I'm keeping it finger crossed. Otherwise, I would have given a very good guidance for the current if that commodity, the volatility part did not have happened actually. So if I have to spell out around 3,000 to 4,000 rupees per ton increase in the commodity prices in the last 4 weeks actually. But we cannot go back to the customer overnight because we need to follow the Lakshman Rekha rule that I need to wait for 1 quarter and then only I can go to the customer. Otherwise, customer also what will do whenever there is a price reduction, next day morning you will come and say ask me to reduce the price reduction actually. So this always the business 1 quarter up and down will be there. So considering all this overall, I don't see any the risk in the commitments what we are making. One is on the top line or on the margin. So there are 3 positive things. There is a 2 things which I want to mention of the commodity. Overall, we should be able to do fairly than barring the if you take the exception as the Q3. So Q1, Q2 level definitely we should be able to do actually.
Fair, sir. Fair. I think certain challenges are beyond our control, and we fully appreciate it's easier said than done to just give guidances and execute on ground. So no harm done. So just one last thing. In your presentation, we can see some new products on non-wind castings. Is that the case? Maybe the coal pulverizer or such, where we've gotten certain new products, new orders, new customers. And lastly, what would be our order book as of today? If you can help us with this.
Actually, recently only I came to know because L&T has approached us that there is a big casting requirement. We were also not aware. They themselves approached us. When I explored that, I came to know that Government of India has cleared 80,000 megawatt of conventional power installation actually. Today, L&T and BHEL is sitting with huge order backlog, which is beyond their capacity actually. So that takes us this order book what we have done. We are expecting this order book is to be for next upcoming 10 years. So that's the kind of thing. looking at the schedules what they have given based upon the share of business, because today I have a purchase order only for the development order, I fairly expect around 20-25 crores annual business coming from this particular customer, this product which we have received the order actually, And again, this order may materialize in the second half of the next year because it will take about 6 months for the development activity. So thereafter, it should contribute to the revenue actually,
Perfect, sir. Perfect. Thank you. I will join back the queue. If you could just probably mention the order book that we have. I don't think it's there on the presentation. Would be very helpful.
Actually, we have put an executable order book on the current year, but next year I think we're not mentioned. But I can spell out actually. As far as the order book is concerned, I see somewhere well above 500 crores. Actually, the key is how does the customers take off and how the execution happens. These are the two elements actually. And the second thing, as I mentioned, Nitinji has asked me the same question earlier. The kind of projections customer has given, this order book exceeds 650 to 700 crores. But we believe there will be some element of discounting happening from some of the customers because of what they project and what actually happens. So that's how we are saying fairly we should be able to do well above 500 crores. This is how we are estimating for the next financial year.
Thank you. Thank you. That's all from my answer.
Thanks, Path. May I request Mr. Pratik Jain to unmute yourself and go ahead with your question, please?
Hey, hi, sir. Thanks for the opportunity. So my first question is, given the new developments, there has been a delay in ramp up. In your view, what is the reasonable time frame by when you can sweat out the incremental 15,000 ton capacity?
See, as far as the capacity is concerned, should not take more than a quarter actually, 3 months period, because once the erection is completed, then we can deploy the new manpower, train them and take up that. There are two aspects. One is the addition of the capacity or equipment installation and other things. Second thing is the product development. We have already taken up a lot of product development activity that includes Senvion. I'm quite happy to say that the current quarter increase what I am talking about, 4 megawatt product we developed last year actually, but now that is getting materialized in a big way. We are doing almost a very good production actually on that. And we have also completed the Envision development, but due to customer commercial reasons that did not take off, but that we are ready to move actually. It's a good sizable the capacity. Third thing is the Nordex development what we have done. We already successfully developed India's largest the wind turbine part for a 5 megawatt platform. Almost 20 castings were done. With trade tariff barrier going away, I see a good volumes coming from the export market. So overall, if I look at the majority of the product development we are through, means we had 4 customers product development. Generally, each product development takes 6 to 8 months actually. The only one product development is lying, that is on the Adani. We already produced the pattern samples are in development. Barring that, we have already got out of the development phase actually.
So if I have to summarize, then can this 45,000 metric ton capacity get fully sweated out by next year?
See, the challenge how it happens is the Q1, Q2. Typically, if you look at the Indian engineering businesses, the Q1, Q2 is 40% and 60% happens in the second year. So just capacity is getting materialized. So somewhere around 85-90% capacity we should be able to utilize in the next year actually.
Got it. And so my second question was, in the press release, it was mentioned that there was some impact on margins because of discount given to the customer. Can you please explain what exactly is this?
See, we have negotiated a contract with Vestas, particularly the export market, starting from January for the US market to be shipped out of from the Kolhapur actually. Means that is not on January, it is a full financial year. They negotiate the prices, the interest market on a calendar year basis, that is January to December basis. So at the time when we were negotiating, there are a lot of tariffs and other things. So we were looking at a cost out ideas. So that includes the elimination of the logistic cost, that is one, plus the benefit of some of the things which I was mentioned in many of the calls, we wanted to pass on something to the customer. Both to put together, so discount was offered. Now, what is happening is what customer is saying, Vestas, the inventory, the orders which I have released for January assembly is for the next financial year. So we ended up in passing on that revised prices from the Q3 of our execution itself. So that is how, since still I am continuing to machine from the outside, but the prices are belonging to the machined in house and shipped from the Kolhapur. This is the major difference.
And if I have to from my understanding, can we take these margins back up again after some time?
Yeah, see, this is the additional cost we're incurring today is because of I'm going all the way to Chennai and getting it machined and sending it to US market. Otherwise, I can very well supply here directly from Mumbai to US actually, no. So this cost will be temporarily till my machine shop gets approved and supply happens from the current brand.
Super. That's from my end.
Yeah. Thanks. Mr. Amitabh, can you please unmute yourself and go ahead, please?
Yeah, I hope I'm audible. Yes, sir.
Yes, sir. Amitabh. Please go ahead. Yeah.
Yeah, I have one question which is a kind of follow-up from last Q1 FY26. You had said about Siemens Gamesa order being actualized in this Q3. I think that was the timeline given. So, and so far I've not heard about the update on that. So what is happening?
Yeah, you're right. Again, the Siemens Gamesa ownership was getting changed. Another, I think you rightly pointed out, this year revenue growth was purely dependent on all four new major customers, actually, that is on the Envision and Siemens Gamesa or Nordex. These were the major things, actually, Siemens Gamesa, they were projecting to take off from, I had schedules beginning from the third quarter. But actually, when company migration happened, there were a lot of procedural things inside the organization, actually. Finally, they took hardly 3-4 sets in the end of the December. But now, current quarter, they are giving the schedules, actually. So almost there was a pushback about a quarter by Siemens Gamesa as well, actually, on the takeoff.
Okay. And you spoke about some approval from Envision. So we got approval for 3 megawatt or 5 megawatt?
It's 3.3 megawatt, but we are developed right now. I think they are building around 1,400 turbines. So that translates into around 50-60,000 tons kind of demand is there, actually. We are expecting at least 10,000 tons from Synergy contribution to their takeoff.
Okay. And so Envision is, I mean, are they taking similar supply from anybody else in market in India? Or you are the
today they are 100% importing from China. Yeah, no, we are the first supplier to develop that product. Otherwise, it is coming from China today. In fact, they were bringing it in a CKD condition, so semi-assembled condition from China. But government of India has bought a regulation; they cannot bring a CKD more than 200 turbines or some 200 megawatt. There is a regulation, actually,
Right.
So in line with that, they initiated development. Synergy was the first company to come forward and the development this product. Already we have developed the product. First part is already assembled. Turbine is gone ahead, actually. But we were supposed to get a serial production this thing. So there was a quarter delay. Like there was some other commercial discussions came on related to some warranty and other things. So then finally it got sorted out, actually. So I am expecting from Q1 onwards, the Envision revenue should materialize.
Okay. And sir, anything you would like to talk about on the industry level, like because I've heard some of your competitor has also started expansion. So are we gearing up for our future expansion, or how you are looking at the supply side of the things?
See, if you look at last 6 months or 8 months, a lot of positive things are happening in the Indian market, actually. First thing is the Indian market competitiveness have dramatically improved because the yuan-INR relationship has changed. INR has depreciated almost 15%. So that gap, whatever was there between China and India, that has vanished, actually. Means now there is more incentive for the local OEMs without looking at the Chinese suppliers to buy everything from India, actually. This is one. So I see a positive effect on our country. The second thing is last 3-4 years, if you look at, in fact, many of the calls I have highlighted this, I also did not understood the thing. A lot of solar installation was happening without much growth in the wind sector, actually.
Right.
At the end of the day, you cannot survive round the clock energy only with solar, actually. Wind has to catch up. So now what has happened, the Maharashtra MSCB around 3-4 months back, they've come with a regulatory thing saying that they are penalizing solar generation by 25%. And they are giving incentive by wind by 25%. Means the tariff difference between wind and solar has made a 50% difference in the cost. Now everybody is rushing behind the wind turbine installation because there is no power generation is happening in the evening hours. The significant pump injection is happening in the daytime because of a lot of solar installation happened in the last 3-4 years, actually. So that is also giving a very good demand for the industry, for the wind sector, actually. Both industry side, improvement in the market conditions. Second, supply side, currency has played a big role to cater this demand to the domestic players like us, actually, no. So these are the two things I see positive, and everybody is doing expansion. I know, in fact, Better also trying to add another 15-20,000 kind of thing. Even SC Ford also maybe thinking, and all of us has got a lot of demand, actually, no. I see, particularly if you look at the export market and all, many people are looking at non-Chinese the supplies. So all of us has got enough market to play this game, actually.
Last time you were talking about some deemed export benefit not accruing to the company. So is there any change into that stand?
No. That we were not in any benefit.
Like you were saying that there was because you do some bit of 4-5% of your order book is a deemed export. So
it's almost 20%. For example, some of the OEMs like Nordex, Vestas, are in a couple of customers. They buy the casting from us, assemble in India, and export to the US market or European market, actually, no. So that has not changed. There is no regulatory thing. Only the difference in that, if I understood well, in case of export to this thing, they can import the casting from China without a customs duty, because they are going to bring this with an obligation for the exporting, actually, no. Means there will be a 8.3% custom duty difference for the guys one who is a deemed export, actually, no. Yes, that will still continue to be there, but at the end of the day, because of this currency, the majority of the gap has gone away, actually. If somebody is buying a casting, if for a 2-3%, nobody will go away, but if it's a 10%, 12%, definitely they look at the cheaper sources, actually, no.
Yeah, that's not that material.
Yes.
One last question. By any chance, the capex we are doing, 200 crore, does it qualify for any Maharashtra infrastructure definition of large infrastructure project and some incentive in terms of duty?
Yes, we have an incentive. It's almost, I think, 29 crores incentive we got. Of course, I have an approval. I need to claim over a period of, say, 10 years. So I am expecting closer to 2.9 crores per year. We are already having a letter with us. There are some certain conditions. Means I need to do the Maharashtra sales. So when I do it, I get the state GST what we are paying. That will be refunded. But there will always a 12 months lag between execution of the orders and getting back from the government, actually. Yes, we do have a incentive of around 29 crores sanctioned from the government, Maharashtra government.
Okay, but this is a compulsory sales is it binding, like you have to sell it to Seni or somebody who is localized into Maharashtra, because your customer are widespread across India?
No, but we have a good amount of Maharashtra sales customer also, fortunately, because wind industry having two hubs. One is Chennai, second is the Pune. Someone like Senmian, Envision, all are based out of Pune. So I have enough customer base to claim that the incentive what is sanctioned, actually, no.
Okay. That's all from my side. Thank you.
Thanks, Amitabh. Mr. Praneeth, can you please unmute yourself and go ahead?
Yeah, thanks for the opportunity. So one question I wanted to ask, I understand that by 27, you would want to go to the 500 crore mark. But the thing is, production-wise, we still are expanding. And do you think we'll be able to add another 15,000 capacity in terms of production also? Because I think we still have problems, and expanding at that rate is substantially very difficult in the casting usually industry, right?
Should not be a problem. Like I've spoken in the earlier participants' question as well. One is a market business. There is enough business. The second is a product development. That is what the major activity the current year we have taken up. Even though we are all looking at the synergy performance with the year on year, what is not reflecting in this balance sheet is the kind of task we have taken up in product development and also completing the expansion. That is a major milestone which we have achieved in the finance. Of course, we have taken an ambitious goal. Apart from doing these two major tasks, we wanted to grow without failing in the last current to the. Of course, there were some delays in the expansion activities. Barring that, coming back to your question, I don't see any the challenge in ramping up. In the past also, we have grown 30%, 40% kind of the numbers. The last 2 years, 3 years, if you look at revenue, were almost at the peak level because our capacity was at the high end of the utilization. Actually, since new capacity is getting materialized and the products are already developed, we should definitely be able to get a significant revenue growth in the next financial year.
Understood. And one more thing is regarding your power opportunity. So are they also large castings? Are they similar size to the wind castings, or what is the size of those?
Yeah, it's almost 25 ton, 30 ton kind of the castings. They're quite big. And see, synergy strength is in producing the large casting in a repetitive nature. When I go to the non-wind industry, you don't get too many such business opportunities. Since the power sector is opening up, it is new demand which is coming up, So that's why we gone ahead and picked up that order. So we should be able to get a good repetitive business from that sector.
So are margins similar to the wind castings, or are they higher?
Generally, non-wind I get a better contribution actually, no. But only thing we get less opportunity to get a big casting large volumes. But this, yes, should we have a better contribution actually.
So are there any plans of building, let's say, dedicated facility to the power sector? Because you see, there's a huge opportunity, right? I understand that wind is a forte, but would it be possible to also expand, especially you're mentioning that the contribution is also higher for this?
As of now, we are not gone in that direction thinking. We always kept in mind 25% diversifying our capacity to the non-wind segment actually, So many times this thought came, why we should not be operating completely our foundry on the non-wind. Probably if you ask me the same question after 3 years, I may say yes. But as in today, we are trying to add incrementally increase the capacity because we are trying to absorb this 45,000 capacity. And back to back, we are seriously thinking because if this trade tariff and other thing, nothing seriously, anything goes wrong in the next 6 months or so, I see a lot of pressure coming up from the international market for adding additional capacity actually, So we are next to immediate task, we are looking at having completed this 45,000 story in the next 3-4 weeks or so, our focus will be on how do you build the next capacity of 100,000 tons actually, So during that, definitely will not think of building a separate capacity for the non-wind or some kind of thing, but definitely we'd like to add more product mix like the what we took in L&T so that we continue to retain the 25% non-wind portfolio product mix in our business actually,
Understood. And one thing, before the tariff situation, I think we were at a 5% differential in the export market, right, compared to the Chinese. With the yuan appreciating, has the difference disappeared, or how is that right now?
See, this was like I mentioned many times. Our guess is again the China is difficult to predict what price they are selling and all. We try to compare the market study and all. There is around 25% price difference was there. But today I know the landed cost of the majority of the Chinese castings coming to India. I think we are cheaper, maybe 3 to 5%. That's what it appears. Of course, that is impacted with a basic custom duty of 8%. Means we are almost at par, closer to within 2-3% actually, So we are competitive. Now coming to the US market, if you go back prior to the Trump, there was always a 25% tariff on China, and China had a 25% cost advantage. So ultimately, the US market, we did not have any barrier actually, But recently, when the tariffs were increased to 50% and China was enjoying 47%, so there was a significant distortion on account of tariffs actually. But taking back this 50% tariff story back to the 18%, now Indian castings are quite competitive in the US market actually.
But would it be cheaper as a result of the currency this thing, or no?
Yes, today we have become cheaper actually, In India, I'm talking about. And if you add the tariff and all, we are little scared actually, Because I see a lot of social media posting saying that this is only valid till we don't buy any Russian oil from that. I don't know which day, what tariff happens. So I'm not predicting that. But if you look at what is there on the paper today, we are much cheaper in the US market. There is no doubt about it.
Okay. Thank you so much for your answers.
Thanks. May I request Mr. Sunil Jain, please unmute yourself and go ahead. Mr. Sunil Jain.
Yeah, good evening, sir. So first of all, thanks for a fantastic clarification to the previous questions. That solves a lot of doubts. My pointed question is, sir, our finance costs are consuming a significant portion of our operating profits. So does the management or do we have any specific plan for debt reduction or some refinancing over these next 12 months? I mean, how are we going to improve the bottom line? Because this is eating away our profits.
See, you don't look at the profit. Today, what has happened, like as I mentioned, in the last 15 years, our capex was 200 crores. This year alone, it's almost getting doubled actually, And again, when we did not go with a full leverage of our balance sheet. Today, we are at a debt to equity ratio closer to 1:2 actually, Maybe if you look at the next financial year, if everything goes right, somewhere around 16-18% kind of margin, if you do closer to 500 crores plus kind of thing, we may end up in doing early repayment of the sum of the term loans. I don't see as far as the finance cost ratios percentage, if you concern, it should not be more than 3 or 4% of our total the revenue actually. Today you see finance cost higher because completely we're in a project phase, and whatever the capex is done, that does not reflect into the revenue contribution or the profitability contribution actually. This is a temporary period. Probably if you look at Q3 of next year, this perspective significantly changes.
Okay, fine, sir. Thank you.
Thank you. May Mr. Jignesh Vaidya, can you please unmute and go ahead?
Yeah. So, sir, you mentioned that there were increase in outsourcing costs. So, all these costs were related only to machining or any other also?
No. Actually, what is that? Heat treatment, we had a 100% in-house facility actually, no. But I had to dismantle this equipment, relocate to the new plant. So during this process, it almost took 2.5 3 months for me to dismantle and take it. So, but I have schedules and the customer I need to serve actually, no. So we ended up in taking all these castings all the way to Hyderabad and getting it back. Say, for example, I was spending hardly 5 rupees per kg in-house, variable cost. I ended up paying 17 18 rupees per kg, to including transportation and paying additional outsourcing cost, So that is another big addition in the last quarter, actually, this is the outsourcing activity.
So, what would be the quantum of that? Total expense?
That will be closer to some 600 700 tons is the what we have done outsourcing in the last quarter itself. So 1% of margin was eaten away only because of that outsourcing activity, closer to 1%.
Right. And so you mentioned that the Vestas had negotiated a discount. So is this a one-off or every year because of this commodity pricing that we cannot pass on, or we can pass on only after a quarter? We will face such situations in future also?
See, all OEMs are, this is not only for our industry, all engineering industry, there will always be expectation to improve the cost year on year. This is the thing actually, no? Now coming back to specific the current year, we are planning to increase the business and share of the wallet. So we have put an effort to reduce our manufacturing cost by eliminating the logistic cost to Chennai actually, no? That is one, that is which is passed on to the customer. The second is we are also expecting some amount of savings on account of in-house machining actually, because the scrap generation happens, plus the waiting time and all those things. So based upon these discounts were passed on. But today, if you look at in Q3 numbers, what we have executed, still those things are not materialized in our hand, because when we negotiate with the customer, it is not negotiated for a quarter, it is negotiated for the full year actually, no? Because I don't get an opportunity to go and sit with him in the March and again discuss. So this is how it works actually, no?
Right. The final question that you told that you have started one line, so 5,000 tons. So other two lines will be started by March end.
Yes. So basically, the second line is the complete this thing, that is automated line. The one manual line we have already started. So that last month itself, there is a almost 10% increase in the production. In fact, as I mentioned, highest production we done in the last month actually. So once the balance of the line gets completed, we should be able to go up the production of the total for 45,000 tons.
So
Again,
by
when I
March,
mentioned, when I mentioned 45,000 tons, what I was looking at a 90-95% kind of a capacity utilization, we should be able to 90% plus kind of the capacity utilization we should be able to, with a strong order book in hand.
so from Q1 onwards, at least we would be able to utilize 45,000.
Yes, 90% of the 45,000.
Yeah. Understood. Okay.
Yes.
Thank you.
Yeah. You're welcome. Mr. Riken Gopani, can you please unmute yourself and go ahead?
Yeah. Hi, sir. Am I audible?
Yes, please go ahead, Riken.
Yeah. Sir, just wanted to first understand a little bit in terms of, there were some startup related costs and discounts related costs which have also impacted the performance. So if we have to just look at a like to like, if you adjust for the startup or the new, expansion related cost, directionally compared to the same quarter last year, would the gross margins have seen some deterioration, or are they same, or what is the trajectory on the gross margins?
If I have to break up this whole cost, somewhere around 3% margin is on account of the pricing part of it. Out of which 1.5% is in the logistic cost, 1.5% is on account of the price actually, no? 3% has come only because of the revised pricing mechanism. That's one. And 100 basis point, which I discussed with the previous participant on the outsourcing of that activity, the heat treatment. That is, of course, perfectly related to only one particular project, So the 4% is because of these two aspects. There is some marginal contribution of the slightly higher manpower cost because we have recruited the people for the new plant, but still the output has not started contributing, So on an overall level basis, if I take out this noise related to the expansion, I don't see any margin deterioration in this whole thing actually,
So this discount is something that will not continue to be there in the remainder of the year or the next year. I mean,
No, not like that. See, we are going to do the savings that is passed on to the customer, right? So means I am not going to incur when I start machining here. I need not incur the logistic cost which I am supposed to spend. Today I am spending almost 3% logistic cost I am spending to move to Chennai. Actually, that cost get eliminated, so that price get adjusted actually.
So are you so when we sort of indicated initially when we took up this project that there would be about a 300 basis points net improvement in margin because of the machining aspect and about 200 basis point because of solar. So
Yes.
the net improvement of 300 basis point remains even after adjusting for the discount and everything.
Yes, because if you look at the overall, the machining, the cost which we are spending almost 12 to 15% actually, but cost of running is not more than 3%. So almost 7-8% comes. So in that we have factored 4 to 5% cost of this come out, 3% contribution back to our bottom line. This is how we have planned actually,
So let's say when we are in Q4 of next year, when we will have the full capacity running at full steam and you would have the machining also in place, is it fair that you would be somewhere closer to the 20% mark in terms of margins?
Absolutely, you're right. I don't see any challenge in that actually. So that's why I'm barring some commodity here and there, noise of 1% here and there. Always I'm giving a range of 18 to 20%. I don't think any fundamentals have changed as far as this guidance is concerned.
Got it. Got it. And so lastly, in terms of when do you start, meaningful supplies to Envision in terms of numbers and so for Adani as well?
See, as far as Adani is concerned, there are two platforms. One is a 5 megawatt platform and a 3 megawatt platform. 5 megawatt platform, hub and mainframe, the bigger parts, weights are much beyond our capability, which is a 35 metric ton. Our maximum weight is 30 tons only. So they ended up in importing all the castings. As far as the 3.3 megawatt is concerned, those castings fall under 20 to 22 ton actually, So those product development were taken. We have almost poured the mainframe and hub. The second casting is getting poured this week actually. So we're expecting by next month, this development activity of the Adani also should get completed. We're already having a serial supplies of bearing housing, but that doesn't give much. Only around 20 crores business is giving. But with this 3.3 megawatt coming into the picture, we expect around 60 to 80 crores kind of the revenues coming from the Adani as well, actually.
And Envision?
See, as far as Envision is concerned, I'm really scared of the way those guys are asking me the question. They are asking 40,000 tons, 35,000 kind of numbers. Boss, I'm telling first you use the 10,000 tons, we'll talk about the 30, 40,000 tons. Because as I know, they have scheduled for 1,400 turbines per next financial year, the year which is going on, which is a 65-70,000 tons is what they require actually, And back to back, I've already got an inquiry for the 5 megawatt turbine as well. But we are saying, was take off some volumes. So I don't see any big challenge. 10,000 should be fairly easily taken by Envision actually. If you do well, they have an expectation of at least 20-30,000 kind of the takeoff. But unless we don't understand the customer, he consistently take off. We don't want to allocate significant capacity today, but we'll do it this subject gradually. This is also taking us to the second lead. One is the US market improving. Second is this Envision things. I hope today or tomorrow it has to fall in line. There is no second thought about it. So then this becomes a good starting point for now the next greenfield project actually.
Got it, sir. Thank you so much for your answers. Thank you.
Thanks, Weekend. I think I don't see any further hands up. So if there is no more questions, I once again thank all of you for joining us and understanding the situation. Otherwise, just I want to put one simple concluding remark. Fundamentally, nothing has changed. I do know there is an expectation has to happen the quarter and other things, but there are certain things we are going through the transformation period. The three aspects which we spoke, we have gone on the first part, the product development part. We have done it very successfully. The second part, expansion. Yes, there is a delay by 3 months. That is a thing which is beyond our control. And the revenue, I think it's a temporary thing actually, So if all those things are land, there is no reason why results should be lagging. So this much only I will tell and conclude with this. Thank you all again, once again. Thanks a lot.
Thank you.